For a lot of years in my land investing business, there was one big constraint keeping me from doing more land deals. You know what that was? Access to capital. I walked away from countless opportunities where I could have bought vacant land properties at a fraction of their market value. These would have been huge, grand slam deals, but I couldn't do them. Why? Because I didn't have the money, and most of the banks I talked to wanted nothing to do with these deals. These sellers also just weren't flexible enough to let me assign their contract to somebody else or do a double closing, and I couldn't find a local title company that would work with me. These deals required a quick, clean cash sale, and I didn't have the cash. So fast forward 15 or so years, and the world of land investing has changed a lot. Thousands of land investors have entered this industry, which has made some things easier and other things a little bit more difficult. But one interesting thing that's happened is, of the many people who have tried their hand at the land flipping business, some of them have kind of realized that they like the opportunity in funding land deals a little bit better than actually finding the deals themselves. There are a lot of new and even experienced land investors out there who know how to find deals pretty well, but they don't necessarily have the money to take these deals down. And they need somebody to come alongside them and partner with them to do the deal. And that's where these funders come into play. So for the sake of simplicity, so you know what I'm talking about throughout this video, whenever I talk about the person who goes and finds the deal, I'm going to call those people operators. Whenever I talk about the folks who come to the table and actually provide the cash to fund the deal, I'm going to refer to them as funders, okay? Funders and operators. Those are the two parties who come together to make these kinds of deals happen, when otherwise neither party would be able to do it on their own. So whenever a funder and operator work together, usually what's happening is the funder comes to the table and provides most, if not all, of the cash to do the deal. And then when that deal is eventually sold, the funder and the operator split the profit in some way, shape, or form. And this split can look like many different things. Sometimes it's 50-50. Sometimes it's 60-40, it could be 70-30, 80-20. It all depends on the two parties and what both of them are willing to contribute and what both of them want out of the deal when all is said and done. There's lots of different variables to consider. And that's what I want to talk about in this video, is all the different things you're going to want to think through, whether you're the funder or the operator, and things that both parties should be watching out for when they put together this kind of agreement. So after talking with many different funders in the land investing space, none of them do everything the same way. They all have a slightly different approach or a different recipe in how they put deals together or what they consider normal or fair. And I think some of this stuff just depends on those individuals that are involved with the deals, but it also has a lot to do with the standards and norms of how they typically work with the other party. Like, for example, some funders want nothing to do with getting a property sold. They put that all on the operator. It's the operator's job to get that property listed and sold or find a realtor to sell it. Other funders, though, want 100% control over that. They don't want the operator involved at all. The funder will go and find the realtor and select who that's going to be and decide what the listing price and the eventual sale price is going to be, the terms of that sale, all this stuff. So it's hard to make an apples to apples comparison from one funder to another until you understand a lot of the underlying assumptions about who's going to have what responsibilities in getting that deal done. But as many differences as I've seen out there, there is one thing I've seen that's fairly consistent, and that is whoever's putting together the partnership agreement or the JV agreement or the funding agreement, whatever agreement is signed between both parties where it lays out what everybody's going to do and who's going to get what out of the deal, the one consistent thing I've seen is that it's almost always the funder who's putting this together. It's their template that's carefully drafted and crafted to protect the funder, not the operator. So first big lesson here, if you are the operator in the deal, be very sure that you are reading that entire thing from start to finish and that you thoroughly understand everything you're agreeing to. Just because one funder works one way does not mean that the next funder works that same way. And it definitely doesn't mean that that funder has your best interests in mind. They may, be willing to be pretty fair about it, but their first and foremost primary concern is to structure the deal so that they are comfortable, not necessarily that you are comfortable. I'm not trying to say bad things about funders out there, but I have talked to more than one operator, either surprised in a not so fun way, or they may have even felt deceived or conned in some way because of what the funder did, when really the funder was just following the terms of their own agreement. So again, as the operator, be very sure that you're reading that thing, that you understand it. Bring it to your own attorney. See if they can find anything about it that they don't like. Whatever money you end up making in the deal, if anything, is going to be dictated by what's written in that agreement. So there you go. You've been warned. So let's talk a little bit about what this agreement is that you're signing. And why are we signing a funding agreement? Why don't we set this up like a loan where the funder uses a note and mortgage to secure that property and explain all the terms of the loan that they're extending to that operator? Well, the first time I started trying to put together this type of agreement with my attorney, that was how he started trying to structure it. But the problem with structuring this type of deal as a loan is that it makes it a lot harder for the funder to pull out the kinds of profits they want from a deal like this. And frankly, land deals are perceived as more risky, especially by many banks who just won't do them unless you're planning to develop or improve that property. And when you structure this kind of deal as a loan, the funder is limited to making their money based on whatever interest they're able to charge on that loan. And the problem with that is it's hard to charge so much interest that you're walking away with 30 to 50 to maybe even 70% of the profit from the deal when you're only able to charge interest. A court could interpret your transaction as violating state usury laws, and some states have criminal penalties for usury violations, so this is not something you want to mess around with. And while it may not be likely this would happen, it could. And the funder would be taking an unnecessary risk by using documents designed for loans rather than a partnership. So this is why most land funders will use some form of a partnership agreement rather than a loan agreement, because it allows them to truly partner with that loan operator, and in doing so, take home a lot more of the profits once that profit is made. But the thing is, when a funder and an operator are partnering together in this fashion, when they're agreeing to work together for a limited time on one property or one project, there's a lot of different things they need to specify and spell out in that agreement to make sure everyone's on the same page about who has what responsibilities, what the timelines are, what the profit split is going to be, who's going to hold title to that property, who gets to make all the decisions about it, and under what conditions either party could even get kicked out of the deal. So for the remainder of this video, I want to walk you through a lot of these things you're going to want to think about, and also just show you exactly how my agreement is set up so you kind of understand the way that I think through this as either a funder or an operator. Shall we get started? So when you're putting together a funding agreement and you're looking at all the different things to consider over what you're going to put into the deal and what you're going to take out of the deal, whether you're the funder or the operator, there's at least two big considerations to think through before we even start going down this road. First of all, we want to think about how well do these two parties know each other. When I'm a funder and I'm looking at potentially funding a deal with an operator, it matters a lot how well I know, like, and trust that person, and how experienced they are, what their track record is, how smart they are at this business. Maybe they're even smarter than I am. Maybe they know this market better than I do. Maybe they have connections that I don't have. Based on that can justify a whole lot of different things, whether they want to hold title, which isn't normal or common, I don't think, for the operator to hold title, but it could make sense if they really are far ahead of the funder in every conceivable way. Or, for example, how many decisions they get to make. It can also play a big role in determining what that profit split is, either at the very beginning of the deal or further down the road, and or if that operator ever gets cut out of the deal in any way. A lot of different things have to do with how well the funder and the operator know, like, and trust each other. Even if they know each other well enough to have a gentleman's agreement of some kind, there should still be some kind of document just to put everything in plain writing. So if there's ever a dispute or anything comes up in question, you can point back to that original agreement as what dictates everything. If you don't do this, I don't think it's that smart of a decision. Just my personal opinion on that. And I'm pretty sure any attorney out there would agree with me. So the other really big important thing you want to think about is the complexity of the deal. Is this just like a straight land flip where you're buying a piece of land for a cheap price, doing nothing to it, and then listing it for sale and selling it for more? If that's all it is, that simplifies a lot of things. But if it's a much more complex deal where you're buying a piece of land and maybe subdividing it, or getting entitlements, or rezoning it, or even developing it, something like that, there's a whole lot more moving pieces in that, and just a lot of other things to think about in terms of the timeline of when all of those subdivided properties end up selling, if you're doing subdividing, or when those entitlements will be done, or what kinds of costs are involved to actually make these things happen. A lot more to think about. So again, the relationship between the operator and the funder, along with the complexity of the deal. These are two really big things that can change a lot about how this can and should be laid out. But when I am funding a deal, and I'm going to kind of explain this from the standpoint of a funder, because we're talking about the funding agreement that I put together with my attorney. But as a funder, there's kind of two different scenarios that kind of determine a lot of different things. So scenario one is probably the most common scenario that most funders deal with. This is where I don't necessarily know the operator that well. Maybe I've never worked with them before. Maybe they're even a beginner, but we don't have a long history together. They may tell me they're the best thing in the world, but I just haven't seen that, or I don't know them well enough to verify that kind of thing. So given that lack of history and experience together, there's just a lot more question marks and a lot more reasons why I would want to safeguard myself and sort of put myself in a really good position just to make sure if they go rogue or do something dumb, it's not going to hurt me. So that's scenario one. And again, I think that's where most funders are coming from with most deals. But there's also scenario two. And this is where I do know, like, and trust this land operator. I've known them for a long time. I've seen their long, successful track record. They're frankly smarter than I am at a lot of things. They know the market better than I do. And there's going to be a lot of ongoing work required in this land deal, whether it's to subdivide or get entitlements and that kind of thing. And they need to do that work, not me, which means they need to be making a lot of these decisions along the way. They're going to have to sign a lot of things, and I don't necessarily want to get bogged down with having to make a lot of these decisions for them. I kind of want to give them the freedom and autonomy to just manage this process because I trust them. So those are kind of the two different scenarios, and you'll understand why I'm laying out these scenarios in just a second, because one of the first things we're going to have to think through and make a decision on is who is going to hold title to this property for the duration of owning it, regardless of how much or little we're doing to this property between the time that we buy and sell it. Someone's got to hold title to it. And I'll just say there's several different ways you can hold title. You could hold title together as co-owners or tenants in common or joint tenants, depending on what state you're in. But it kind of muddies the water a little bit, and it can kind of stall things in some cases because both parties have to sign the deed when it gets bought or sold. And by and large, I just don't think it's necessary as long as you document this clearly enough in the funding agreement. So you could co-own it, but most funders I know don't do this whole co-ownership thing. Another option would be to create a new LLC to own that one property, and that LLC could be co-owned by the two parties. But that's also a little annoying because there's a lot of paperwork you got to do to create that LLC and then a new bank account and all this stuff. And I don't think it's worth that for most smaller land deals. And when I say smaller, I mean like $500,000 or less. However, I will say when you're doing big syndications or much more complex things like in the millions of dollars that go on for years, then it could make a lot more sense because it's just a much more significant deal with a lot more money on the line, and it could justify that. But again, most of the funders that I know who work in that $500,000 or below, or even the $1 million and below range, they don't do this whole creating a new LLC just for that property. What I usually see is the funder is on title. The funder owns everything. And honestly, this makes a lot of sense to me because the funder is the one putting all the money on the line. They're taking all the risk. If anything can go wrong, they're the ones who have to bear that financial burden and liability. So it makes sense to me for the funder to own the whole thing. However, I will say in some of the deals that I've funded, there have been situations where I've let the operator have title to the property. And the only reason I was willing to go there is because I knew, liked, and trusted this operator. They were smarter than I was. They knew a lot more than I did. And most importantly, I wanted them to have the freedom to make a lot of decisions and just get the job done without having to call me to get me to sign off on things, every other week for whatever they were working on. I wouldn't even go down that road of the operator holding title unless it's one of those special relationships where you've got a long history together and you frankly trust them implicitly. And I will say, in this kind of funding arrangement, when one of the two parties is going to hold title and the other party will not hold title, the question then becomes, okay, as the person not holding title, how do I protect myself? Do I have any security in this? How do I make sure if this other party that does hold title, if they just try to cut me out of the deal, do I have any hammers? Since I don't have a mortgage like a bank would, how do I make sure I don't get hurt? And one of the possible answers for this, I actually heard about this from my friend Eric Sharaga, is for whoever that person is who is not on title, for them to file what's called a notice of interest on the property. And it basically is just a one-page simple document just letting the public know in connection with that property, hey, if anybody else is trying to buy this and you're doing your title search to make sure it's clear, just know there is this funding agreement in existence and I have an equitable interest in this property due to that funding agreement. So it's one of those things where it's not exactly a lien, it's definitely not a mortgage, but it's enough to cloud the title and in most cases put a stop to that sale if that other party tries to go behind your back and sell it without paying you down. In a lot of cases, title companies can even wire you funds based on this. Not all the time, kind of depends on the state and the title company, but at the very least, it's one of those things that would give you some nice teeth just to make sure that that other party can't go behind behind your back to do something without your knowledge. So if that's something you're concerned about, just be aware of that. And by the way, I do have a notice of interest template you can use for this, along with my funding agreement template, which I'm going to keep talking about here. If you ever need a funding agreement template or a notice of interest template or anything like that, I have them for you. And obviously, I'm not an attorney. This is not legal advice. Be sure to run this stuff by your attorney if you decide to use either one of these things. But if you're watching this video on YouTube right now, I'm going to have a link beneath this video that goes to a blog post. And if you scroll to the bottom of that blog post, that's where you can get these templates. So now that we've discussed some different options for who can hold title, let's talk about some other brass tacks and just basic fundamentals of this kind of funding agreement. So first of all, who's going to pay for all the costs? Like who's going to pay off the seller and cover closing costs, cover holding costs, cover any improvement costs, all this stuff. And for me, that answer is almost unequivocally me, the funder, because I'm the funder. That's my whole fundamental role in this deal. That being said, though, that doesn't mean there can't be situations where the operator can't cover some of those costs. For example, what if the operator wanted to cover some of the improvement costs because they're going to be involved in making some of those improvements or entitlements or whatever it is they're doing. Whatever you're going to do, you just want to spell out really clearly, if the operator is covering any costs, what are they covering? Like up to what amount? Just be really specific about how much cash they're contributing to that deal. And then when it comes time to actually do the deal, like stick to those numbers. Don't mess around with them and do something different than what you said in that original agreement. And if you do, just have really clear written communication between both parties about who's covering what. And if the operator does cough up some of their own cash to do this deal and get it done, that could pretty reasonably justify a higher percentage of the profit split when all is said and done. It may not necessarily, change who's going to hold title to it, but just be aware that may be one reason why an operator might expect a higher portion of the profit is because, they're putting more capital into the deal if they have it. One other thing I've seen, not very often, but I have heard of this, where sometimes the funder will pay for the operator's marketing costs, like their direct mail or however they're finding the deal in the first place. I've never even considered this, and the main reason is because as the funder, I have no control over the operator and how they're handling their acquisition strategy, like what marketing channels they're using, how good of a job they're doing with that. I don't want to give them a blank check to just spend however much money they want to find the deal. As an operator, their whole job in this process, like the real value they bring to the table is their ability to find deals. And however they do that, it's not really my main concern. But I will say, I don't just want to fund their whole operation, because that's kind of their territory where they determine their own costs and strategy and however they want to do that. So I don't get into that. And however much they end up spending to find the deal, it doesn't really change much in terms of what percentage of the profit they get in the end. And if they don't like the profit split, then that's kind of up to them. They don't have to work with me. But on that whole subject of marketing, we also got to think about the marketing to get this property sold in the end. So whose responsibility is that going to be? Is that going to be the operator going out to list this on different listing websites and sell the thing? If so, do any of those listing websites require money to get the job done, like the land.com network or, some other paid website where you list this? Or are they just going to be using Craigslist and Facebook Marketplace and that kind of thing? If there are costs involved, you got to decide who's going to pay for those costs. I can tell you, in my view, as the funder, I would be willing to front those costs because, once we own the property, I'm in it. And whether I like it or not, it's my co-responsibility to help get this thing sold in whatever ways I can control that and get it sold for as much as possible, as quickly as possible. So I should be willing to pay whatever's necessary to get that thing sold. Another way to do this, though, is to just find a land specialized real estate agent who can do this all for you. And I like this approach because usually when you're funding a bigger deal like this, it's probably not going to be a tiny rinky-dink property in the first place. It's probably going to be fairly easy to justify the involvement of a good realtor and pay whatever commissions are required. So in a lot of cases, it just makes a lot of sense to do that. It also kind of adds this third party into the mix, kind of like what a title company does in a way. Let's say you give it to a realtor and that realtor is not getting the property sold. In that situation, it's not the funder being mad at the operator, or it's not the operator being mad at the funder. It's both parties being against the problem, which is the realtor. And it doesn't solve the problem, but it kind of can potentially mitigate some animosity that might be brewing between both parties if the property isn't selling as fast as both parties had hoped. And also, you got to think, okay, who has the authority to make a decision for which realtor we're going to hire? Again, that can go either which way. It kind of depends on who has the most expertise in that market and who is willing to do the homework to find a good realtor, but that's another decision you would want to make together in your funding agreement. Another thing for the operator to think about as we're thinking through this whole process of getting a property listed and sold and who has the authority to make those decisions. So one thing I've seen from more than one funder out there is this provision in the agreement that if the property doesn't sell by X date, then the operator gets a little bit less of the profit because the funder is having to sit around and wait longer to do it. Or in some cases, once we go past a certain deadline, a lot of times it might be like 12 months or a year, that kind of thing. If it doesn't sell within a year, the operator is kicked out of the deal and they get nothing. And the funder just takes over and they sell the thing and they keep 100% of the profit. I'm not saying that's right or wrong, but I am saying as the operator, if that's something you see in there, just be aware you'll want to have some control most likely over who's going to list and sell the property or what platforms it's going to get listed on. Because think about it. If you're going to get penalized because the property didn't sell fast enough, it sure well better be your fault for not working hard enough to get the job done. If it's all on the funder, if it's their job to find the realtor or to communicate with the realtor or even list the property and sell it themselves, but they're not doing their job, why should you be penalized for that? It's just kind of like a common sense thing. And, it's something an operator might not be thinking through if this is their first rodeo. So just be aware of that. And I'll also say some funders don't do this at all. Like, it doesn't matter how much time it takes, the operator is always going to get their cut of the deal. And if that case, that simplifies things for the operator because there's nothing to worry about, really. And I will say, in my funding agreement template, the way I have this set up is there is a place where you can put this kind of deadline over if it doesn't sell by X number of days, this happens. But rather than just kicking the operator out arbitrarily, there's actually like a buyout agreement in there where once we hit this period of time, if the operator wants, they can buy out the funder. So you can stay in the deal, but pay the funder off plus a premium for the time that they've had their money in the deal. And if they don't want to do that, then the funder can buy out the operator. And what that really means, buy out, because again, the operator may not have hardly any money into the deal. What that essentially means is whatever money the operator has put into the deal, say they put $1,000 down to cover the closing costs or something like that, the funder will pay them back for all of their capital contributions plus a premium just because their money was tied up in the deal. So the operator isn't getting completely kicked out. At the very least, they're getting compensated for whatever money they put into it plus a premium of some kind. That's how I have mine laid out. It just seems like the fairest way in my opinion, but it's up to you. Again, if you want to use my template, you can get it below. So another interesting thing to think through that you might not think about up front is who gets to make decisions on which realtor we're going to pick if you're picking a realtor, what the starting listing price is going to be, and what if you have it listed for 3 months and it still hasn't sold? Do you lower the price? If so, how far are you allowed to lower it? And at what intervals can you lower it? Or what if you get an offer to buy the property for seller financing, but in the original agreement, that wasn't really allowed for? Does the funder get to say, yeah, I think we're going to take that offer? Things like this. There's a lot of different variables that can come into play in terms of how this property might eventually be disposed of or, how it might sell. So you got to think about who gets to make those decisions. Is that the operator or the funder? You could even set it up so that there's voting authority. The funder has a 51% vote and the operator has a 49% vote, just so that somebody can overrule the other. But what you wouldn't want to do is give yourself perfect equal authority so that you can disagree and then get stuck on this. That's what you don't want. So somebody should be able to have this authority to make these decisions. And again, kind of going back to who holds title, that kind of thing. Usually I've seen this fall to the funder because it's their money and they have the biggest vested interest in this property, so they get to make the decisions. But again, it just depends on the specifics of your deal and the different parties involved. Now, another important thing you want to think through is this whole thing is based on the two parties getting a certain percentage share of the profit when all is said and done. But how do you measure profit? What does that really mean? And what kind of costs get paid for out of that eventual sale price before you call it profit and then start splitting up those proceeds? Is there some kind of a waterfall setup where this party gets a preferred return first and then we split the profit? That's something you want to think through. The way I have mine set up is, we basically cover each party's capital contributions first. And once all that stuff is covered based on, closing statements and receipts and all this stuff, then we make the profit split based on whatever percentage shares we both agreed to up front. And on the subject of profit, something else that may not be as fun to think through, but it's still important to think through nonetheless is, what if there is no profit? What if this deal loses money? Does the funder just kind of take it on the chin and say, well, that was too bad. Let's move on to the next one. It's just something to think about. It's not likely if you're doing things right, but it's certainly possible. My funding agreement template has a provision in there that just explains, both parties understand that there's inherent risk in this deal. It's possible we can lose money. And if the deal does lose money, as the funder, when I'm funding deals, I basically just say, wow, that stinks. But that was the risk I took when I did this. And also, events of default. The word default, this is basically these are the things that the operator has to do, or the borrower, for example, if it's a bank, the borrower has to do these things. And if they don't, they're in default. So a lot of people think of this as like, yeah, if the borrower stops making their payments, they're in default. And that is certainly one example of default, but it could be other things. Like if it's a commercial small business loan or something like that, you could be in default if your cash flow coverage ratio isn't high enough. Like your business isn't making enough money to make us comfortable. So now you're in default. And now we can just come take all the money and take your stuff and all this. So you want to define, what does default mean? What does the funder expect of the operator, and under what conditions would that operator be in default? I mean, there's obviously tons of ways you can set this up. But the way mine is set up is a handful of different things. First of all, if the operator, let's say if it was their job to get the property sold and they just weren't doing anything, and I as the funder can document that, they're in default. Or say if the operator is an LLC and that LLC gets sold to somebody else. So all of a sudden my partner is not the same person I signed up with. This other company owns it now and I never agreed with them. Now they're in default. Or what if this LLC that I partner with, the LLC that's the operator, what if the owner of that LLC died? Like what if the person I agreed to partner with isn't that same person or entity anymore? Those are events of default, just to give you an idea. But you'd want to think through that. In your situation, what would you consider to be unacceptable? Like at what point is that person in default? And then also another really important thing here is one of the two parties should be responsible for all records and bookkeeping. So one interesting thing about this kind of partnership arrangement, when I first started trying to do this and I was working with my attorney and CPA on this, they were actually both of the opinion that if I were to sign this type of partnership agreement with somebody, this would actually require like a partnership tax return and other like accounting hoops and stuff that I'd have to jump through. And at first I was like, what? Like, no, like I don't know any funder out there that has to file a separate tax return just for this one deal they're doing. And one of the ways you can, by the way, again, not legal advice, not accounting advice. Don't listen to what I'm about to tell you. But one potential solution to this, to get around this requirement, is to have this provision in your agreement that just clearly spells out each individual party is responsible for filing their own tax returns with respect to whatever profits they make in this deal. And one of the two parties should be responsible for maintaining all of the records in bookkeeping. When you think about this, this is kind of just a common sense thing. I mean, there should be one person who can say, yep, I've got all the information. If you have a question about that receipt or what happened on this date or how much money was spent on this, both parties shouldn't be standing around going, I don't know. One person should be able to keep track of all this stuff and be able to produce that information, those documents, if and when they're needed. So whoever that's going to be, that person should be identified in this agreement. I will say, I think in most cases, it usually makes the most sense for the funder to be this person, just because it's their money and all this stuff. But again, it kind of goes back to that scenario 1, scenario 2 thing, depending on what's going on in the deal. I have had deals where the operator held title and they were the person responsible for all the records and bookkeeping. So it could certainly happen that way too. It's just up to you. But the point is, one of the parties should be identified as the person responsible for that. So that covers not everything, but most of the stuff to be aware of. And again, if you want a copy of my funding agreement template and notice of interest template, along with video tutorials explaining how to use each one, be sure to check out the blog post. I'll have a link to that beneath this video. Or if you're watching this video on the blog right now, all you have to do is scroll all the way to the bottom and you'll find where you can get copies of those templates for yourself and get started. So thanks for watching. I hope you found this helpful. I think funding is an amazing opportunity for both parties. It really does create win-win situations. And it lets both parties do things they otherwise would not be able to do on their own. So it's a beautiful example of partnerships, but they still need to be done right with a lot of different details and things to be paid attention to. So hope you found this useful. Thanks again for watching. Talk to you next time.